Good morning and happy Memorial Day week. I hope you are ready for a wonderful week. As you would know, the world economy certainly didn't slow for our Memorial Day, but we just want to say thanks to the families that are sacrificing, the ones that have their kids across the ponds doing service today for our country, and obviously those of you that have served. We greatly appreciate it. We know we would not have what we have had so many people not sacrificed for so many years in so many ways. And just have a great Memorial Day. Be with your families. Enjoy it. But don't forget to say thanks to a vet, and if you are one, know that from the bottom of our heart you have our gratitude and our thanks. Well, as the world economy and the United States economy continue to reach all-time highs, or I should say market, not economy, obviously, interesting things are happening. Adam continues to say we just got our 81st indicator that the market is now ready to take a correction and pull back. And obviously that's a joke, but seriously, the amount of short interest, the amount of margin debt that's out there, just many different indicators are out there that say this has got to take a breather of some nature, and yet the market continues to propel higher. You've heard us say, you've heard a lot of people say, the market can remain stupid longer than we can remain financially solvent, and that is very true. There is a lot pushing this market up. We need to understand what those drivers are. A lot of people, myself included, believed for a long time it was the Federal Reserve putting money into the system, and I think that's really what did it. But I think to a degree now, people's heads are at a point where they just anticipate it going higher, and we're having families that call that a year ago said, I don't want to have anything to do with any risk, that are now saying, what risk? Things change, and we have to be able to manage those emotions. Remember, there are two that drive a market all times: fear and greed. And the fear is always the stronger of the two. That's why markets, when they pull down, pull back quicker than they went up. We have to be alert. We have to be careful. But as well, we have to manage a market, and it is what it is. And this thing is continuing to try to go higher. Just no question about it. The question is, when do we get the pullback that at some point in time you have to believe is coming? Let's look first at the new fall. This is a fundamental part of the leg. Very interesting thing. When we look at the earnings yields of companies in the S&P 500 right now, we're at about 6%. You compare that to the yield on the 10-year U.S. Treasury, where you're literally looking at about 1.9, 1.92 right now. That is 3 times. It's greater than 3 times yield in the earnings of companies than it is on the U.S. Treasury. Now, that in itself doesn't necessarily connect. The earnings companies have yield, but that's not all distributed. Yield of a Treasury is. Here's the important relevance, and you can see from that chart. It's that divergence. It's that change. And if any part of you believes in the reversion to the mean, you believe either bonds have to go up in yield, which means vastly down in price, or earnings of companies have to fall. And what we're seeing in this segmented economy is some earnings are actually doing better. Some of the research that Andrew came across last week literally showed that the index is rising faster than the market capitalization of companies. And in short, what that means is companies are buying back so much of their own stock that even though the price is rising, the number of shares that have been pulled off the market cap, if you will, is diminishing. Very interesting insight into some of the things that are going on in the marketplace. The second thing is looking for yield pushes a pile of junk. Junk bonds, you've owned them before in HYG, in an exchange-traded fund, just continue to push higher and higher. But what you will notice is that wedge, the bottom line being what we call support, the top line being resistance, is getting thinner and thinner. And when that tends to happen, it eventually has to push out one way or the other. It's either going to go to big new highs, or it's going to come tumbling down. So we're watching it very closely, but it is interesting how that wedge, if you will, is tightening. Last year the talk was the Occupy Wall Street, all the things that were going on, kind of crazy. This year, those big boys are getting very little attention. They had a thing in Washington, and 11 people showed up. Just a massively different thing. And I talked a little bit about this when I came back from the TD Ameritrade conference. One of my favorite authors, Malcolm Gladwell, who wrote Blink and one of my favorite books, Outliers, actually talked about this and what it takes for something to be successful. Occupy Wall Street had no direct purpose, no direct leadership. People showed up, but they didn't know what to do once they got there, and they didn't have a way to keep it going, keep it running, if you will. Interestingly enough, that seems to be the case now. The attention seems to be off those big boys. Though there's been a lot going on in Washington. The the attention over Tim Cook being brought into Congress to talk about the taxation of Apple, and as well as Jamie Dimon's board of directors at J.P. Morgan and Chase, and the conversations that are going on there. So there is some attention. It just doesn't seem to be coming from the public. We seem to be enamored by the returns. What the heck? We'll just let it go, right? The dormant Japan is now coming back. As you may remember, Japan peaked back in December of 1989. The Nikkei, literally 38,925 points, fell all the way into the low, probably in around the 5,000 era on the low. They've been in a period of deflation, had negative interest rates for a period of time. The Prime Minister last year swore that he was going to do whatever it took to fix it, and literally has made their quote-unquote QE programs, like we're doing here at the United States with Bernanke and the Federal Reserve. He's made us look like we're sissies. I mean, he is really pumping the money in and brought down the value of the yen to the dollar to 100 yen to the buck. It's not been that low for a long time. And remember, Japan is an export economy, so that is very, very good for their economy. Their Nikkei is on a huge run. It's hard to be able to invest in to get reasonable returns because we're investing in the value of the dollar, right? And their yen is falling, so it's not the same return we would have if we were able to invest it in yen. But interesting, it's a large economy, and we certainly have to be able to watch it. Barry Ritholtz is a friend of mine that I met in New York City years ago. He writes a blog called The Big Picture. Does a great job, and I love this rule: follow discipline religiously. You know, we have to look at this market and make the decision on what we're going to do. Every morning I second guess myself in terms of what we own, why we're doing it, and that's why we have that discipline. It keeps me, even though emotionally I may second guess the decision, we have a process, and that process has got us through a lot of storms. We've got to continue to follow it, understand how it works and what it does, and make sure that we're following the risk profile that we have set for the families that we serve. So if something's changed in your life where that absolute long-term tolerance has changed, where your financial vision may have changed, then we need to change the risk profile that you're taking. On the other hand, if we're just frustrated because the market's going up, when you get into the bottoms of it, and I'm gonna write an article about that, but some of the research we're seeing is it's the companies that are driving the market the highest right now are the ones that you wouldn't want to own if you cared at all about business models and fundamentals. Think late 1990s companies with no earnings in the tech wreck and what happened, and not just in the uprise but in the wreck part. Some interesting and challenging things that are taking place there. As you know, this year we're the title sponsor for the Paul's Golf Tournament. Would love to have you. I believe it's June 6th. You are more than welcome to come support the charity. Have a great day of golf. It's going to be at the Edge Club here in Anderson. So you can give us a call at 800-928-4001. Ask for Larry or anybody who answers the phone can help get you signed up. If you're out and about Saturday morning, don't forget to catch the radio show, 9 to 10 on WQME, Sunday mornings 10 to 11 on Shine 99. Of course, you can find it in our newspaper column on the website at yourlifeafterwork.com. Folks, we appreciate all you do and the faith and the trust that you put into our firm. We will continue to do the best we can for you based on the things that we see that are going on inside of this world. And one more time, happy Memorial Day weekend. Spend some time with your family. Thank you so much for your service and for all that you do. God bless. Have a great weekend. We'll see you again soon.